Good evening, everyone. I am CA Mayur Moda, moderator of this webinar. We are delighted to welcome you all in the webinar being organized by Continuous Professional Education Committee of ICAI. It is my pleasure to be moderator for this session on new regime versus old regime in ITR filing and RERA and its changes in the real estate industries. In a short while, we will start with the webinar. Before that, I would like to apprise you about the CPE committee. The role of chartered accountant is evolving continuously to accept newer responsibility in dynamic global environment. The future of CA profession depend on being flexible and open to innovation. Therefore, the need of R is to innovate as per requisites of the contemporary business environment and accordingly upgrade the curriculum and education system of chartered accountancy course. The committee also believes that member of ICAI should look beyond the traditional area of practice and seek explore new areas of business and profession. And hence, the CPE committee is mentoring the members by providing guidance through various workshops, seminar, national conferences, background materials, etc., and simultaneously by encouraging young and dynamic professional to grow as a speaker in a various seminar and ceremonies and CPE programs. We are pleased to inform that ICAI is organizing its first ever Global Professional Accountant Convention, that is GLOPAC, on theme Connecting Globe, Creating Value from November 24 to 26, 2023 at Mahatma Mandir Convention Center, Gandhinagar, Gujarat, India. GLOPAC is being celebrated as a mega event to display the important role that accountancy profession has been playing in building stronger and more stable economies around the globe. It would provide an opportunity to global market to network with best finance and accounting talents in India. Now I am playing the teaser for a GLOPAC that is ICAI has launched.
It gives me immense pleasure to announce that the Institute of Chartered Accountants of India has decided to organize its first ever Global Professional Accountants Convention, GLOPAC, on the theme Connecting the Globe, Creating Value on November 24th to 26th, 2023 at the Mahatma Mandir, Gandhinagar in India. GLOPAC is being celebrated as a mega event to showcase the important role that the accountancy profession has been playing in the economic and social development of our country.
Globalization has made the world one village, and the services of chartered accountant are also available globally without any boundaries. The Institute of Chartered Accountants of India is also devoting significant efforts towards global networking. The convention shall be attended by more than 3,000 delegates from around 40 countries. I would like to extend a warm welcome to the fraternity on behalf of ICAI to attend and participate in the first ever GLOPAC.
ICAI is geared up to welcome delegates from across the globe at the GLOPAC.
Now, I request everyone that you have seen this GLOPAC teaser. I request all the participants please register themselves if they have not registered for the GLOPAC, and I have also registered. And the program for this evening is follows. We have two sessions, 1 hour each. First is new regime versus old regime, and second is 6 years of RERA and changes in the real estate industries. Our eminent faculty will talk about the mention to emerging areas of professional interest. And now I would like to introduce our chairman of a CP committee before he deliberate for the session. CA Purushottam Khandelwal. He is a chairman of a CPEC, vice chairman of committee for members in entrepreneurship and public serving, and convener of RBA Directorate of ICAI. He is having a 25 years post-qualification experience in the field of audit, direct tax and indirect tax and intellectual property rights. This year, he is devoted to fortifying a CPE framework and guaranteeing quality across its entire operational spectrum. And this year, major focus would on upgrading of CPE portal for enhancement of the branding and professional competency of members. I would like to add further that note written in his profile. When I have started my practice in 2013, he is the chairman of Ahmedabad branch. Since then, I am looking him in ICAI at various capacity. He is serving the profession. With this brief introduction, I request Chairman Purushottam Khandelwal sir to deliberate for the session.
Good afternoon, respected faculties for these 2 hours. One is for CA Palak Pavagadi ji, another is Sarthak Bhansali ji. Palak Pavagadi is known for the taxman in Ahmedabad, just like a Girish Ahuja at Delhi. He is a very learned faculty. Another two moderator. One is Mayur Moda, Honorable Secretary of CA Association and my dear friend. And another is Chandli Torani. He is the chairperson of Gandhidham branch. Office Secretary of the CP Committee, Ajitnath Tiwari ji, and respected members. It gives immense pleasure to be amongst you that this year President has given me charge as the chairman of the CPE committee, which is the most important committee and mother of all this committee. Its chartered accountants are providing services to the profession, to the various capacity to the clients, and it is important for them to be updated each and every time. Nani Palkiwala rightly said, before giving any advice to client, you please refer to the books. So it's very, very important that what we are selling our services. So our services should be very, very updated and up to the marks, which is because when you are dealing with the outside world, you are all the brand ambassador of the ICAI. And this year, ICAI is celebrating 75th year of the inception. And today, which is the teaser displayed by the Mayor Moda, and I was a witness of the teaser launch at today at the Statue of Unity at Kevadia Colony, Gujarat, where all the government nominee and the members, those who are the disciplinary committee of the ICAI, were there. So on the front of this, all the renowned stalwarts of the ICAI, the logo has been launched by the President, Sri Aniket Talati ji, and Vice President, Sri Ranjit Kumar Agrawal ji. This year, we are continuous touch with the government. We are working with government soldier to soldier. Before this Statue of Unity program, we have been organizing one program at Srinagar, Jammu and Kashmir, that we call all these chartered accountants, those who are on the Union Public Service Commission, public service. So whether they are the IAS, IPS, politicians, or income tax commissioner, revenue departments, and then we try to understand what the expectation of the government from those who are dealing with the other side of the table. So instead of doing a lot of works, and my committee at the moment rightly said that we are doing a lot of works, and this year we are focusing on the technology, and this year important announcement that we have rolling period is not nowhere there, so you have to complete your CP in this calendar year only. That intention was that when we have to provide services this year and update knowledge next year, there is no meaning. So जो काम आज करना है उसी का knowledge आपको आज ही update करने का है. Then we first time bring to the India, and then followed by the UK. UK also changed the 3-year rolling period, and they are also come with the 1-year rolling period. My vice chairman is in Singapore, and ICAI is for the first time in the history of ICAI under the leadership of Aniket Bhai, president of ICAI. ICAI is organizing event outside the India at Singapore Resolve for the very important insolvency professional from world's insolvency professional is coming to the Singapore. I am also joining today evening. I am also going to the Singapore, and most of the our council colleague will be in that Singapore. So he's not attending the this seminar, but he's well wished with us. He told me that you give my best wishes to the participant who was learning from that. And absolutely, the Palak Pawagadi is a very, very renowned person. I always full respect to the Palak Pawagadi sir, and they are the faculty here. So I will hand over charge to the Palak Pawagadi ji. Thank you so much.
Thank you, Chairman sir, for your deliberation for the session. Now, before I hand over the charge to Palak sir, I want to give his introduction for the session. Having an experience of 23 years post qualification, Pawagadi sir has an expertise in the area of direct tax, audit and assurance, inbound and outbound transactions. He is a rank holder and gold medalist in the chartered accountancy and university exams. He is co-opted member of a board of studies of ICAI Delhi for the year 2023-24. Also, he is appointed as a board committee member of a Global Business Roundtable, that is GBR, and GMFJ, and Association of South Africa. He is also delivering lectures at various professional forums on the subject of direct taxes at national level. And I would like also add that same that I have added in Purushottam Khandelwal sir. I have learned my income tax I, that direct tax D from Palak sir in 2009, as he was the visiting faculty when I was studying CA. With this brief introduction, now I'd like to request sir.
I think current president also learned income tax from Palak Pawagadi sir. He was your student, no?
Sir, you can now start with your webinar.
Good afternoon, everyone. Respected Purushottam Khandelwal ji, very renowned professional from Ahmedabad, my very dear friend and chairman CP committee. Gyanchand Mitra ji in absentia, the vice chairman, Ajit sir, secretary, Pragna ji, other office bearers, my co-faculty Sarthak Pansali ji, Mayur Modha ji, as well as Chandni ma'am, the moderator, all the office bearers of CP committee, and seniors and my dear friends. I'm indeed very thankful to CP committee for giving me this opportunity to share my views on the tax regimes. To be honest with you, when the government took over the charge, not this government, but each and every government says that our planning is to make the tax returns and the income tax structure, or maybe GST structure, simple, so that normal person earning salary or earning business or earning any income would be able to file his or her return on their own. That's how they came out with all e-filing and other things. But at present, to be honest with you, the situation is that it's quite difficult for not even the layman, not even the assessee, but even we professionals also to understand which regime to be followed, whether it should be old, whether it should be new. I'm dividing my presentation into two different parts. Part one is still after July also we are pending with the return of September, October. The assessees who are subjected to audit, or the partners of firm or LLP if the firm or LLP is subjected to audit. So that is for assessment year 23-24. For them, which regime to be selected. So that would be my first part of the presentation. And my second part of the presentation is going to be what would be next. What would be for previous year 23-24? That's going to be assessment year 24-25, wherein there is 360-degree change. Let me begin with the year 2023-24 assessment year. As all of us are aware, the old regime talks about 2,50,000, 2,50,000 rupees, 0%, 2,50,000, 1 to 5 lakh, it is 5%. 5 lakh to 10 lakh, it is 20%, and above 10 lakh, it is 30%. So this was going very nicely, and we were able to claim all the general deduction, LIC, Mediclaim, PPF, donation, and whatnot. 24B, interest on borrowed capital for the house property, and standard deduction, and many other things. But the Honorable the Finance Minister ma'am came out with the new section 115 BAC, wherein she has provided the concessional rate of tax, wherein she said that your slabs will be 250, nil 250, 1 to 5 lakh 5%, 5 lakh to 7 lakh 50,000, it is 10%, then 15%, then 20, then 25, and then above 15 lakh only, it's going to be 30%. I am talking about the year 22-23 financial year, assessment year 23-24. Now, if you follow this, obviously this is beneficial. But if you are following this, there would be number of benefits you have to give away. This is subject to subsection 2 of section 115 BAC of the Income Tax Act. 115 BAC 2 says that you cannot claim the following benefit. Number 1, standard deduction. Number 2, entertainment allowance. Number 3, professional tax. These are connected with the salary. Number 2, you cannot claim interest under section 24. For very, very important to note, many people are committing the mistake here for self-occupied property or for the property which is considered to be vacant property. The 2 lakh rupee maximum deduction which we are claiming cannot be claimed under 24B. You would be able to claim municipal tax, you would be able to claim standard deduction, you will be able to claim the interest of the let out property also. I repeat, you will be able to claim the interest of the let out property also, but you cannot claim interest on self-occupied property wherein you are taking your gross annual value to be 0. You cannot claim loss under the head income from house property for rented house also against any other head. So you can claim the interest. Like if my rent is 10,000 rupees per month, multiplied by 12, 1,20,000, I got 30% charge deduction, 36,000 rupees. So that gives me the balance 84,000, and I've paid the interest of 50,000, perfectly permitted. No problem, I can claim 50,000 and I can have my house property income to be 34,000 in the new regime. But if my 84,000 is the NAV and I have paid the interest of 90,000 and there is a loss of 6,000, that loss of 6,000 I cannot set off. So interest on let out property can be claimed, but if due to this there is a loss, that loss cannot be set off. From the business profession, you cannot claim additional depreciation. For manufacturer, additional depreciation under section 32(1) Roman 2A cannot be claimed. Normal depreciation we are permitted to claim in the new regime. You are not able to get various donations or various expenditures under section 35 scientific research. You can claim scientific research expenditure, revenue or capital you can claim. You can claim the expenditure incurred by you 3 years prior to the date you have commenced the business for scientific research, but you cannot claim the donation only. 35AD, that is the income-based deduction for, investment-based deduction for the specified. Section 57(2)A, that's the deduction for family pension cannot be claimed. Other deductions under section 57, like you have got, say for example, interest income and you have paid the interest, then interest paid claim can be claimed under section 57, but only family pension related expenditure cannot be claimed. And unfortunately, general deduction cannot be claimed. Friends, You are not able to get ATC, ATD, ATG, ATGGC. You are not able to claim ATTTA, ATTTB. No deduction can be claimed by. Now, the position is the government is giving us concessional rate on one side, and on the other side, government is taking away a number of benefits. So it would be we who have to decide which regime to be opted. Now, the technology is so smart that when we prepare the return, our software or departmental utility itself suggests that your old regime, if you have not filed Form 10, i.e. your old regime has got the tax payable worth, say, 4 lakh rupee. And exactly besides the same, they will give the calculation as per new regime, your tax payable is 392. So it would be open for us to ask the client that, sir, would you like to go for 392 or not? But that would be only when, number one, the software or the utility is showing this. Number two, when we see that, important is, in the rush of 31st July or 31st October, we are so occupied that whatever is done last year, we continue. And if you have not seen, the client may be at loss. So we'll try to find out the simple way to decide which regime would be applicable to your client, looking at the preliminary information only. But if I go to general issues first, assume my client is earning 6,50,000 rupees income from salary. Assume his salary is 50,000 rupees per month, and he has got 50,000 rupee bonus. So that's how he has earned 6,50,000 rupees. He got standard deduction of 50,000. He has not made any investment. He may be the tech guy wherein he believes in working for 5 days and spending for another 2 days. So no investment, no saving he has made. His income would be 6 lakhs as per the old rate, old regime. And as per old regime, old rate, his tax payable will be 32,500 rupees without sales. I am calculating. So he will pay 32,500. But if the same gentleman is going for the new tax regime, then in that case, out of 6,50,000 rupees salary income, can I say he will not be able to get the standard deduction, because 115 BAC into bracket 2 says standard deduction is not available. So if he is not getting standard deduction, his net taxable income or net total income will be 6,50,000. As per the new regime, if we calculate the tax 2 lakh 2 lakh to 5 lakh, it would be 5%. That would be 12,500, and 5 lakh to 6,50,000, it's going to be 10%. So it would be 15,000. Your total tax payable will be 27,500. Here in the new tax regime, there is a benefit of 5,000 rupees. So advisable that assessee should opt for new tax regime. We will be discussing if he opts for new, what would happen. Number two, we will be discussing that if my assessee is opting for the new regime, what is the procedure? Can he come back to the old or not? We will check this out. But this is first. Now, in the new and old, we can see there is a benefit of 32,500 and 27,500, that is 5,000 rupees. How come this 5,000 rupee benefit is coming into play? See, as per old tax rates, your income was 5 to 6. That means income was 6 lakhs rupees. So up to 5 lakh, whether it is old, whether it is new, the tax rates are similar. Above 15 lakh also tax rates are similar. Whatever the gap is there between 5 lakh 1 to 15 lakh. Now, above 5 lakh, can I say my assessee has got, as per old regime, 6 lakhs rupee income, so 1 lakh rupee income. On 1 lakh, he ends up paying tax at the rate of 20% in the old regime. So that would be 20,000. If he would have opted for the new regime, his income will be 5 lakh to 6 lakhs 50,000. That is, above 5 lakh, he has got 1 lakh 50,000, which falls under only 10% bracket as per the new regime. So his tax would be 15,000. And the difference between 20 and 15 will be a benefit of 5,000 to my client. So that's how the whole things will be, I would say, be working in, friends. That's how the whole things are going ahead. That's how he is getting the benefit of 5,000 here. See, if we check out with 9,50,000 income, as he has started earning 9,50,000, he has understood the benefit of saving and investment. So 950. If assume his salary income 50,000, 1 lakh rupee ATC he is enjoying, LIC, PPF, etc. So his income as per the old regime is coming to 8 lakh. That comes to 72,500 rupee. If we go for the new tax regime, it's going to be 9 lakh 50. On 9 lakh 50,000, neither he will get standard deduction nor his income will be 9,50,000, on which if we apply the new tax regime, the tax will be 67,500. So can we say there is a benefit of again 5,000 rupees to my client? We want to check out with this 5,000 also, we can check 5,000 in this particular fashion also, friends. But there is a benefit of 5,000 to my client available over here, and my client should opt for, the assessee should opt for the new tax regime. Now, if we go for 13 lakh rupee earning, and out of 13 lakh rupee earning, he has invested full amount in LIC PP of 1,50,000 rupees. He has paid mediclaim for himself 25,000, mediclaim for parents 25,000. He is having in this 13 lakh saving interest also, so he is eligible to get 80 TTA also, and his taxable income is coming to 10,40,000 as per the old regime. Tax payable on old regime, applying the slab 2,50,000, 250 to 5 lakh, 5%, 5 lakh to 10 lakh, it is 20%, and about 10 lakh, up to 10,40,000, it is 30%. He's having 1,24,500 rupee tax payable. But if he goes for the new tax regime, neither he will get standard deduction, nor he will get the ATC, nor he will get ATV, nor he's going to enjoy even income side deduction. So his taxable income will be 30 lakh and his tax payable will be 1,37,500. Look at the point. What is beneficial is the old regime. I repeat, what is beneficial is the old regime. We cannot generalize and say that every time the new would be benefited. No. Here, the benefit will be as per the old regime. Say if he's earning 20 lakh rupee and he's getting 50,000 standard deduction, he's getting 2 lakh rupee HP interest. He has got the loan for the house property, he has bought his own house as his income is increasing. He is having LIC PP of worth 1,50,000 rupees. NPS also he has started, ATCCD 1B, 50,000. Mediclaim, 25,000 for me, 25,000 for my parents, I am paying 50,000. I have got saving interest also, I'm claiming 10,000 saving interest. So my net income after getting the benefit, look at the benefit, 2 lakh plus, rather I start with 50,000 start deduction, plus HP interest 2 lakh, plus 1,50,000, plus 50, plus 50 and plus 10. I'm having the total benefit over here worth huge amount. And after this total benefit, my income is coming to say 14,40,000 rupees, on which my tax payable will be 2,44,500. If, friends, I go for the new regime, no deduction, nothing, no LIC, no HP interest, because I assume this HP interest is for self-occupied property, and my tax payable is coming to 3,37,500 rupees. Beneficial is old regime. Here also I'm getting the benefit as per the old regime. Now, how the things are working in, if you want to generalize for the year for which you are filing the return, friends. As I have said earlier, up to 250, there is no difference in old and new. Between 2,50,001 and 5 lakh also, there is no difference in old and new. I'm coming to 87, a rebate and other stories slightly. Third, if we check out with the slab of 5 lakh 1 to 7 lakh 50,000, as per old, it is 20%. As per new, it is 10%. So, can I say on that 2,50,000 rupees income, there is a tax advantage of 10%. That is 25,000. If you would have gone for the old regime, you would have paid between 5 lakh 1 to 7 lakh 50,000, 20%. That would be 50,000 rupees. If you are going for new regime, you are paying 25,000. That is only 25. So there is a difference of 25,000. There is a benefit of 25,000 as per the old, my mistake, as per the new regime. Now, when we go between 7,50,000 1 to 10 lakh, as per old regime, it would have been 20. As per new regime, it is 15%. So there is a benefit of 5%. 2,50,000 multiplied by 5% will give you 12,500 would be the benefit. So up to 10 lakh rupee income, I assume the client is not having standard deduction, client is not having any general deduction. Then in the new regime, there is a benefit of 37,500. Between 10 lakh 1 to 12 lakh 50,000 in the old regime, it would have been 30%. In the new regime, it is 20%. Between 10 lakh 12 lakh 50,000 1 to 15 lakh in the old regime, it would have been 30%. In the new regime, it is 25%. So again, on 2,50,000, there is a benefit of 10%. And on that 2,50,000, there is a benefit of 5%. 25,000 and 12,500. Karke, your total benefit is coming to 75,000. Above 15 lakh, whether it is old or whether it is new, all are equal. For 5 minutes, assume that client is not having any general deduction, any 24B, any standard deduction. Is simple as I say, getting remuneration from partnership firm and interest from partnership firm worth, say for example, rupees 15 lakh. If he's getting 15 lakh or say 18 lakh or say 20 lakh, if he has to decide whether he should go for old or whether he should go for new, then I think very categorically he should go for the new, because in new there is an exact benefit of 75,000 plus obviously health cess and education cess. But in the practical life, there are general deductions also. In the practical life, there are 24B, there are section 16(1) standard deduction also. So to generalize, if my client has the income worth 17,50,000 and above, and if my client is having general deduction worth 2,50,000 and above, rather more than 2,50,000, then it is always advisable to go for the old regime. I'll justify how. One thing is certain in all in our mind, that in the new regime, keeping other thing constant, no general deduction vagera, there is a benefit of 75,000. Now above 15 lakh, up to 17,50,000, there is a tax bracket of 30% as per the old regime, as per the new regime both. If there is an income of 17,50,000 to my client, and my client has invested 1,50,000 in ATC, NPS 50,000, and 50,000 in Mediclaim, that is exactly 2,50,000. Then as per the old regime, his income will be 15 lakh. And on 15 lakh rupee income, my client would be ending up paying tax of 2,62,500 rupees. You can calculate on your calculator. I'm just doing that. But if my client opts for the new regime, then as per the new regime, his tax payable will be 12,500 plus 25,000 plus 37,500 plus 50,000 plus 62,500 rupees. Plus on 2,50,000, there is going to be 30%. So if you check out, it would be exactly 2,62,500. The situation will be neutral. If he has got income of 17,50,000 exact, and if he has deduction eligible in old, not in new, exact 2,50,000 is at neutral part. His income is assumed 17,60,000, and his deductions are 2,60,000. You calculate what is more beneficial is the old regime. But if his deductions are 2,40,000, what is more beneficial is the new regime. The reason being, 75,000 is a tax benefit under 30% bracket. So for getting that 75,000 benefit in the new regime, if we check with 30%, then 30% is to 75,000. How much is 200? That would give you, friends, 2,50,000 rupees. You make the investment of more than 2,50,000, and the old will be beneficial. You make the investment of 2,50,000, both would be neutral. You make the investment of more than 2,50,000 rupees, old beneficial. Less than 2,50,000, it would be new beneficial. But this would be applicable only when your NTI exceeds 17,50,000 only. Then only this would be applicable, else not. Now, the situation in our Gujarat, I assume this would be the situation applicable across the country, is that people are coming with the asking us to make the planning for the whole family, that who should pay the Mediclaim, who should pay the LIC, who should pay this, that. Assume there is an income of husband worth 20 lakh, income of wife worth 18 lakh. Both are working. And their total investment in ATC, ATD is 2,50,000. Say both are partner of the partnership firm, rupee remuneration. Now assume that husband is investing, say for example, rupees, say full 2,50,000. Then as per the old, his tax payable will be, can I say, rupees 337,500, and as per the new, his tax payable will be 337,500. How come 337,500? The reason being, friends, can I say as the general deduction is exactly 2,50,000, both would be same? The benefit of 75,000 which is available in the new regime would also be available in the old regime, as the income in the old regime is going down. But say, for example, if we check out with wife earning 18 lakh and assume wife is not investing a single rupee in LIC, PPF and Mediclaim. Why she is not investing a single rupee in LIC, PPF and Mediclaim? The reason being, I say, as husband has already paid LIC, already paid PPF, already paid Mediclaim, 2,50,000 is a total amount to be paid by the family. Wife is not paying. Obviously, wife would be having benefit in the new regime, and that benefit to wife will be worth 2,50,000. Sorry, yeah, worth 75,000 rupees. How come 75,000 rupees? Above 50 lakh you go. If I keep other things constant, no general deduction, no stand deduction, no 24B, she has got the benefit of 75,000. So here my advice would be that clients should opt for old for husband and new for wife, or new for husband and new for wife. The reason being, husband would be tax neutral in both the situation. Wife, if not investing anything, then she should be going for the new one only. But assume that general deduction of the family is 5 lakh rupee. Then in that very case, if I go on advising that both should invest 2,50,000, 2,50,000. If both are investing 2,50,000, 2,50,000, our answer will be very simple, that whether you go for old, whether you go for the new, it would be one and same. Assume husband invests 3 lakh and wife invests 2 lakh. Then also according to me, it's going to remain the same. You calculate. The reason being, husband is getting a benefit in his return, which wife is giving away. So friends, 5 lakh, it's going to be the same. Both are investing, I would say 250, 250 each. Now important is, sir, assume that here the investment is more than 5 lakh. Then in that very case, I'll be honest in saying that, friends, if investment is more than, in that very case, if they are investing, it will be beneficial. How to exercise the option? If you've got business income, this is for the old one. If you've got business income, while filing 139.1, I'm very specific with the red color 139.1, which is written in bold, which is highlighted, that when you file the return, which is in time return, you have to exercise the option by filing form number 10 IE. And this option would apply to the subsequent year. Yeah, you have right to come back to the old once in the lifetime, but once you come back to old, you are not allowed to go to new. That was announced by the Honorable Finance Minister. In all other cases wherein there is no business income, while filing 139.1, you can exercise the option every year. Last year you have gone for the new. If you current year you want to continue, you have to put continue. If you want to come back, you have to say opt out, and you can come back to the old one. Now next year again you want to go to new, you are allowed to go to new. You are eligible to claim the benefit of old new. You can switch over from old to new to old every year. As all of us are aware that from financial year 23-24, the new regime has been made the default regime. So when we want to go for the old, I'm discussing, we have to file this type of form. But the point which you need to keep in mind is that this option of changing the regime, or rather opting for the new regime, if you are opting for it for the first time, the new regime need to be selected by filing form number 10IE on or before the due date of filing of return under 139.1, which was 31st July, or now going to be 31st of October. Many clients are calling and saying, or many good professional friends are calling and saying that I am trying to file my ITR in the month of December, which is belated or which is revised, wherein I'm not able to file form number 10IE to select the new regime. Someone told me new regime would be more beneficial. I said, yes, it is more beneficial, but you are not able to file because they have not mentioned 139.4 or 139.5. So very important point to be kept in mind is that this is to be selected while 139.1 only. Do not make a mistake. It should be in the original, and I would say it is only in the in-time return. Now, certain important issues. Would 87A benefit be available in the case of the new regime? Now, Honorable Finance Minister herself has announced that yes, it is eligible. So 100% yes. Can the senior and very senior citizen, that 3 lakh, 5 lakh wala limit, be applicable to them? No, it is 2,50,000 in the new regime only. Salaried employee got the TDS done as per the old regime. And now they want to file the ITR as per the new regime, or vice versa. Whether it is permitted? Yes, it's permitted. Non-business income can change the option every year? Yes, they can change the option every year. There is no problem. Business profession SSC wants to change? As I have said, no. As I'm trying to tell you, old return filed as per the original return filed as per the old. Now new return as per the new. Whether it is permitted, not permitted. But friends, important is that if my client is non-resident individual HUF, they want to take the benefit of the new regime. Are they allowed to take the benefit of the new regime? There is no prohibition. This is available to individual HUF and everyone. So they can get the benefit. There is no problem at all. You are allowed to take the benefit of the new regime. Now, this was related to the year for which we'll be filing the return. I'll take next 15 minutes for the year in which we are sitting, for which we'll be paying the advance tax on 15th of September, or for which the salaried people have given the declaration to their employer. 2023 budget, 1st February 23. This being the full-fledged last budget before the Lok Sabha election, the Honorable the Finance Minister made an announcement that up to 7 lakh, there is no tax payable. People were so happy that there is going to be basic exemption limit, which is increased. No, there is no increase in the basic exemption limit. CS made change under section 87A, rebate available to individual resident only. So this benefit is only for individual resident, not to even Hindu undivided family friends. Second, not to non-resident. She has made a drastic change in the tax slabs. Like we'll be discussing now 3 lakh, I would say gaps, or I would say slabs she has come out with. Salaried people would be able to get standard deduction even if opting for the new regime. And surcharge rate is also reduced for the new regime from 37% to 25%. So Madam Ji wants that, the Honorable the Finance Minister wants that those who are earning less should also come for the new, which is a default regime for the financial year 23-24. Those who are earning very high, like Mukesh Ambani Ji, should also be following the new regime, because they'll be following new regime not due to this ATC, ATD and the stories which I have made, that 2,50,000 wala, but he would be opting for the new regime due to nothing else than the rate of surcharge, higher rate of surcharge. If we analyze what I want to convey, this is my new regime. My new regime says, the tax new regime says that up to rupees 3 lakh, there is going to be 0%, 3 lakh 1 to 6 lakhs, 5%, 6 lakhs 1 to 9 lakh, it's going to be 10, 9 lakh 1 to 12 lakh, it's going to be 15, 12 lakh 1 to 15 lakh, it's going to be 20, and above 15, it would be 30. Meaning thereby, we have removed the slab of 25% from the new. Old remains the same. There is no change in the old. But she has made 2 big corrections. Honorable Finance Minister made 2 big corrections. Said individual resident would be able to get 87A if opting for the new regime. See, 87A is now divided into 2 different parts. Individual resident opting for old regime would be able to get 87A if the NTI, if the total income doesn't exceed 5 lakh, and their 87A will be 12,500, or actual tax payable, whichever is less. There is 87A available when you go for the old regime. But when you go for the new regime, 87A is available to individual resident if income, total income doesn't exceed 7 lakh, and rebate under section 87A will be rupees 25,000 or actual tax payable, whichever is less. Now, if we check out, I am earning 7 lakh rupee. remuneration and interest from my partnership firm. I don't have any other income. I don't have any general deduction. I don't have any other thing. If I calculate my tax on 7 lakh, can I say up to 3 lakh rupee it is 0%, 3 lakh 1 to 6 lakhs it is 5%, so that is 12,000. My mistake. 3 lakh 1 to 6 lakhs it is going to be 5%, that is 15,000, and 6 lakhs 1 to 7 lakh, that is on 1 lakh rupee, my tax payable will be 10%, so it would be only and only 10,000 rupees. My total tax comes to 25, which would be rebated under section 87. Now assume that if I am earning 7 lakh 1,000, I'm not going to get any rebate. जैसे हम लोगों का हो ही रहा है 5 lakh 1,000, you are not getting any rebate under section 87A for the year 22-23 financial year. So same way you will not. Here also Honorable Finance Minister ma'am has given some relaxation. I'm coming to that relaxation given by her. But the second big change made by her is that the rate of surcharge for individual HUF, AOP, BOI, AJP, artificial judicial person, if income exceeds 5 crore and they've opted for the new regime, the rate of surcharge cannot be more than 25%. In the old regime, if they go for above 5 crore, then the tax surcharge will be 37%. But if they go for the new regime, their surcharge rate will be only 25% in place of 37. Now, this is a basic chart I have given as per old and as per new for the 22-23 and 23-24 comparison. In a lighter note, if I say that when the budget came and I was delivering the budget lectures continuously, I'm fond of movies and this web series. So at that time, that web series Farzi came, Shahid Kapoor, that currency notes, wherein they were talking about Farzi note, old wali, nai wali, like that. So when I was dealing with this in my first budget session, I was remembering that new, yeah, only new. Old remains the same, but new getting changed in the financial year 22-23 and in the financial year 23-24 with, I would say, big change. So how much should I pay? I have given 2 slides only for your reference. I'll be sharing this immediately with the committee and which would be made available to you. Now, same way if we go for the illustration, it goes this way. Assume my salary income is 7,50,000 and my standard deduction is 50,000. In old regime, my income comes to 7 lakh and my tax payable comes to 52,500 rupee. If I go for the new regime, my tax payable will be in new regime also. I am not getting any benefit which are enumerated under 115 BSc 2 earlier, except from the financial year 23-24, if I am opting for new regime, general deduction is not available. 24B, as I have said, self-occupied property not available, let out available, additional debris not available, but I'm going to get standard deduction. So if I get 50,000 rupees standard deduction, my income will be 7 lakh. On 7 lakh, as per the new regime, my tax payable will be 25,000, which would be rebated under section 87, and my total tax payable will be 0. So what is beneficial is the new regime. If I increase my income from 7 lakh 50,000 to 10 lakh and standard deduction 50 plus LIC premium 50, my, as per old regime, tax payable will be only on 9 lakh rupee, 50,000 standard deduction, 50,000 LIC, and my tax payable on, as per the old regime, the rate remaining the same, will be 92,500. But if I go for the new regime, I'm not going to get ATC, but I'm going to get standard deduction. My tax payable will be on 9,50,000. So that would be 52,500. New is benefited. If I increase my income from 10 lakh to 15 lakh with LIC premium from 50,000 to 1,50,000, can I say, oh, here, my old regime gives me everything. Standard deduction also, LIC premium also. So it would be 13 lakh. If I calculate the tax on 13 lakh, it would be 202,500. But if I go for the new 15 lakh, I am going to get only one deduction, and that is standard deduction. On 14 lakh 50,000, if I pay the tax, it would be 1,40,000. New regime is beneficial. See, government is trying to force everyone to remain in new regime. I'm repeating the word. Government is forcing everyone to remain in the new regime, being the default regime. From the financial year 23-24, New regime is going to be the default regime. If you want to go for the old, you have to file the specified form. 25 lakh rupee salary, and you are having standard deduction, or you are having LIC premium, and you are having house property interest. As per the old, your income will be 21 lakh. Tax payable will be 442. As per the new, it would be 24 lakh 50,000, while tax payable will be only 4 lakh 35,000. The way we have generalized with 2 lakh 50,000 for the year 22-23, if I try and generalize as per the new, can I say, friends, up to 5 lakh, assume my income is 20 lakh, up to 5 lakh, old new is similar. 5 to 15, old new is different. And then above 15 also it is similar. So if we calculate the tax as per old and as per new, and find out the difference up to 15 lakh rupee, then in that very case, whatever the difference comes, we divide by 30%. If that much benefit we are having, old new will be same. If it is more than the same, old would be beneficial. If less than the same, new will be beneficial. Like if you are earning 50 lakh rupee salary, as per the old regime, you are allowed everything, NPS and everything. Your income comes to 45 lakh 50,000, 11,77,500. As per the new regime, you are getting only and only 49 lakh 50,000 rupee income, and your tax payable will be 11 lakh 85,000. So here, if I want to generalize, I can put it this way. You can try out. If your tax payable, if your deductions are rupees 3 lakh 75,000, additional benefit is 3 lakh 75,000, except standard deduction. Like my client has paid in the given case LIC worth 1 lakh 50,000, house property worth 2 lakh, and NPS worth 50,000. In place of 50,000 NPS, had this been 25,000 NPS, then can I say my income would have been in the old regime 45 lakh 75,000? That means additional 25,000 ke upar I would have ended up paying 30% tax. That is 7,500. My tax payable would have been exactly 11 lakh 85,000 rupees. And as per the new regime, my tax payable is also 11 lakh 85,000, meaning thereby, if your income is above 18 lakh 75,000, I repeat, if your income is above 18 lakh 75,000 and your tax benefits are 80C or 80D, except standard deduction now, is 3 lakh 75,000, you are at par. Above 3 lakh 75,000, old will be beneficial. Below 3 lakh 75,000, new will be beneficial. At the same time, if we check out with that margin leave given by Honorable the Finance Minister, like if you are earning 7 lakh 15,000 rupees, your tax payable is going to be 26,500. Now, had this been 7 lakh, your tax payable would have been 0. And earning 15,000 extra is making you liable to pay the tax of 26,500. That is an injustice. Honorable Finance Minister ma'am said that there is going to be a margin leave worth 11,500, which would be available, and 15,000 you need to pay, plus obviously 600 rupee HEC says you are supposed to pay. So the point is that as far as this tax structure is concerned, wherein Honorable Finance Minister has said that in the year 23-24, new regime is going to be the default regime. Number one. Number two, I'm pretty sure that in the days to come, the government will keep only one regime, and that is new. If I informally say this way, it was Honorable Finance Minister, the then Mr. P. Chidambaram sir, who once said that I don't want to have deduction and exemption in the tax system, which is very rigidly followed by the finance minister, Mrs. Sitaraman. Number one. Very important thing to keep in mind is that for those who have not given any declaration for their salary in the current year, the HR will be calculating the tax as per the new regime only for 23-24 financial year I am talking about. But if you want to go for the old, you can give the declaration. Your salary is 30 lakh, your investment and other benefits are more than 3,75,000. Give the declaration, you want to go for the old, at least for the current, right? So that would be beneficial. Next year देखा जाएगा 24 का budget आएगा तब mini budget and then full budget after the election. At the same time, another important point you need to keep in mind is that in our country, saving and investment are the basic thing. If there is only new regime, the government apparently is said to be discouraging the saving and investment. But I'm damn confident that the way the mutual funds are giving the return, whether they are tax saving or whether otherwise, it would definitely be government must have something in their mind to have some optional investment. And number of clients in the current year, while filing the return, asking us that, sir, if we go for the new regime, we'll not be able to come back if we have business income. Like now, whatever the returns will be filing for the remuneration interest for individual HUF would be having business. In this case, if we go for the new, we can come back to old only once, and then we will not be able to opt for the new again. Do not worry. If the new is benefiting them, take them to new, because as I'm trying to tell you, from the financial year 23-24, it is going to be the new regime, which is the default regime. If you want to opt for the old, there would be new story for opting for the old. So this is what is from my side. Thank you very much again, all the committee members, moderator, my co-speaker, all the staff members, seniors, and my dear friends for giving me this opportunity. Over to you, Mayur Bhai. Thank you.
Alex sir, we are having a few questions.
Oh, yeah, please.
I'll read out that actually I have received in a WhatsApp message.
Yeah.
First is, as an NRI, can I get additional deduction under section 3CCA for contribution to NPS?
I think as far as 80CCD 1B is concerned,
yes,
there is apparently no prohibition, as I understand. So 50,000 rupees deduction would be available. There is no issue. Still, I'll check out with the act. As Purushottam sir has rightly said, that you have to check the law and get the data. It is 80CCD, I suppose.
Yes, 80CCD.
Yeah. 80CCD. Just a moment, sir. Yeah. There is no prohibition in the law.
Okay.
The produce is individual, so there is no problem. Even non-resident can get. Yes, sir. But the scheme must permit them to contribute.
Second question is, sir, which is more beneficial, old regime or new regime? That is general question.
I've already explained that for the year 22-23, that 2,50,000, and for the year 23-24, that 3,75,000.
Okay, sir. Third question. How person having income up to 7.27 lakhs will no longer have to pay tax as per FM India's statement?
Sir, according to me, up to 7 lakh, you don't have to pay the tax. Above 7 lakh, I think let's not involve into that statement made by Honorable the Finance Minister.
So these three were the questions. Thank you very much, Palak sir.
Thanks you. Thanks a lot, sir.
On behalf of the CPE committee, I would like to give you a hearty vote of thanks for giving us clarity about old tax regime and a new tax regime. As first time when I have attended your lecture, you have same style. Let us understand with basic details and with examples that you have given. So it is very much clear. I hope all the participants, as there are more than 333 participants in the webinar at live. So thank you very much, sir, for enhancing our knowledge. Thank you. Now
Thank you.
I would like to hand over the chat to my co-moderator, CA Chandni Tolani ji, for taking a session further.
Thank you. Good evening, everyone. And thank you, Mayur sir, for moderating the first session. And Palak sir, of course, invariably for such an erudite session, I would say. My dear friends, as we move ahead, we have yet another cardinal topic coming next. That is 6 years of RERA and the changes in the real estate industry. Which shall be addressed by CA Sarthak Bansali sir, Gandhinagar. My heartiest welcome to Sarthak Bansali sir to this webinar. And before I request him to commence the session, let me just acquaint the attendees with his brief profile. Sarthak Bansali is a qualified LLB and FCA. Academically, he had scored the highest marks in ISCA subject across India in CA final. He has also been a rank holder throughout LLB. He has co-authored the landmark book on Gujarat RERA, published by the Ahmedabad branch of ICAI on e-filing guide. He is a distinguished faculty and has taken lectures at various forums, including the ICAI, ITBA, CA Association, Shivalik Institute of Real Estate, and so on and so forth. He's also visiting faculty with Ahmedabad University and Shanti Business School. With these very brief words, I once again ardently welcome Sarthak sir to this webinar. And I request him to now commence his session. Sir, over to you, Sarthak sir.
Thank you, CA Chandni, for the very, long introduction. And, I would like to justify it by saying that the Act itself is very short, just 92 sections. The age of the Act itself is very small, 6 years. So I am here to just talk about how it has moved over the last 6 years and what changes as we consultants have we seen in the real estate industry due to the implementation of the RERA Act. I would like to thank all the organizers and the CPE committee for inviting me to speak on such a topic. I would like to share the presentation and then we can start with the topic for today. Is this visible? Right. So before I move on to what changes has RERA brought into the real estate industry, just to touch upon how RERA has been implemented in the country, just a brief introduction. So it was implemented on 1st May 2017. It was implemented for the entire country. It was passed through an act by the parliament, and the subsequent rules and regulations framing were left to the states. So the power to frame the rules were given to each state governments or the union territories. Then under the rules, the authorities came in, wherein the authorities notified the regulations, brought in certain circulars and orders. And of course, along with those, the judiciary played a very crucial hand. So the RERA authority itself has a mechanism for redressal. So authorities passed orders, tribunals gave judgments on those, and subsequently even the Supreme Court and the High Court, and the Supreme Court gave various judgments due to which effective implementation of RERA could be possible. So the first thing I would like to go through is how is it implemented in the country as on date. So starting with project registrations, Maharashtra has the maximum project registrations for any state in the country. So as you can see, around 108,000 registrations have occurred in the country, wherein 40,000 alone belong to Maharashtra. And that too, of course, because of Mumbai, where the major concentration of registrations occur. Then there is the state of Tamil Nadu, where there are around 17,000 registrations, and then there is Gujarat. So so since RERA is implemented by the rules and regulations passed by the states, so every RERA will have certain unique aspects according to the state implementations. Every RERA authority, say Gujarat RERA authority, Maharashtra RERA authority, or Tamil Nadu RERA authorities will have certain rules framed by the authorities based on the business practices in the individual state. So Gujarat comes the third, which is where from I belong. So I'll be talking more on the central implementation of the act, and also what is happening more in Gujarat, and certain examples of litigation we can take up. Moving on to how I'm going to organize or how I'm going to discuss these topics today. So broad categorization I put in as, so I'll look at sales and marketing and how changes have occurred in the sales and marketing part of the real estate planning. Then project planning itself, how project planning has changed over the years, over the last 6 years due to RERA, what changes we can see in banking and accounting. Of course, what changes are there in the borrowing and the means of finance. And of course, last we can talk about is how RERA has brought in more information and more transparency into the real estate sector. I would start with the first key aspect that has changed, and that is the sales and marketing, and how sales and marketing has changed in the real estate sector due to RERA implementation. So what I've done is, instead of starting with the technical point and then moving on to the conclusions, I rather went into the conclusions and then referred the provisions which are bringing those changes into the real estate industry. So as we know, before the implementation of RERA, the end date of a project was dependent entirely on the developer. A developer would have said, I would give you possession by, say, Diwali of next year, and the actual possession of the project would have been completed probably 2 years down the line. What RERA did is, it asked the developers to give an affidavit saying that the project will be completed on so and so date. So not a random or a inconclusive date, but a particular specified date on which the project has to be completed. So each project has been given an end date. So section 42LC is the provision where this affidavit has to be submitted to the RERA authority declaring the date on which that project shall be completed. Next, what happened was, before RERA, a project would be initiated by a developer. They would deal with the landowners, give a long payment duration to the landowners, start taking the bookings, take money from the allottees, meanwhile paying the landowner as well as putting in some money for the development. After RERA said no. First, you register the project with the RERA authority. Once you register, all the documents have been submitted, those have been verified by the RERA authority, and approval of that has been given. Only then you can market or book. So section 3 came in, wherein marketing, booking, all the promotional activities can happen only once the project is registered with the RERA authority. So even before the project was launched, the developers used to take money from the allottees, and if the project got stalled due to any reason, then the allottees were in a fix. Now, because of the implementation of RERA, once registration happens, only then the selling activity can begin. So, of course, commencement certificate is there for if you want to start the construction, you need to have a commencement certificate. So, for the construction part, there was already regulation that you can construct only based on the approved plans after receiving the commencement certificate. But there was no such restriction with respect to sales of the project. RERA brought in those restrictions and those regulations for selling of the project. Again, section 13(1) says that an amount exceeding 10% cannot be received, cannot be collected from the promoter without first registering into an agreement to sell it. So registration of agreement to sell became a compulsion only post which an amount exceeding 10% was to be collected. What this did was terms and conditions of the sale became extremely clear. Earlier, the agreements were not registered, probably they were notarized or they were signed by both the parties, and there was no registration process involved. Due to these changes, due to the implementation of section 13(1), it is now compulsory to register the document at any point of time once 10% money has been collected. So at the initial stage itself, when the booking is done, 10% is collected, agreement to sell needs to be registered. Next, what changed in the sales and marketing was the amenities that were provided. Usually the promoters used to provide a lot of amenities, lot of promises were made in the brochures, in the prospectus, in the advertisements, and ultimately at the time of deliveries, most of those things which were promised at the initial stage, at the stage of booking, were not provided. So what RERA did was, section 12 stated that if the promoter fails to deliver what is committed, then the allottee has an option either to ask for compensation or withdraw from the project. And the withdrawal in effect will have a refund of the entire money with interest, and additionally you can ask for compensation. So whatever is being promised has to be delivered. So what changed due to this? The marketing, the advertisements that started happening after RERA, after litigations and judgments by the RERA authorities, that once you have committed this in the brochures, in the prospectus, you need to provide those. So once those orders started coming in, we started seeing a lot of changes in the brochures, in the prospectus, that only things that they're sure they're going to provide at the end of the project were committed at the start of the project. Additionally, section 14(2), which says that any alteration in the plans of the project, the prior consent of 2/3 allottees is required. So at the start of the project probably would have been for say 7 stories. The promoter would have gone ahead and started selling. Subsequently, the FSI, the TDR availability changed, and they started developing, or they started changing the plans to a 14-story building. Now, a person who has already bought an apartment and made payments towards this and wouldn't want that change can now oppose. So only if the consent of 2/3 allottees is provided to the developer, he can change those plans. So alteration in plans is one thing that has changed, and hence the marketing for that. So now developers, if they are planning for a taller or a longer storied building, they from the start they inform it to the customer that this is what we have planned, and accordingly the marketing is done. So a lot of changes we have seen in the industry due to certain provisions of the RERA Act, their implementation, and the subsequent litigation and orders passed by the real estate authorities. So I'll just give an example of particularly if I talk about advertisements, what has changed in the advertisement. So advertisement change, advertisement, there's a provision, section 11(2). Section 11(2) says that any advertisement, you need to provide the details of the RERA registration number that you have received, along with the website address where the details of the entire project have been published. So for example, if I take the example of Gujarat, gujrera.gujarat.gov.in is the website address at which details of all the project are listed. So whatever number is being given by the authority, it can be an average version or the full version. Those number need to be displayed on the web, on the advertisements that are being made. So Gujarat RERA has divided into 2 parts: the full number and the average version, and how it has to be used in different scenarios. So if it's a paper ad, it's a newspaper ad, full RERA number needs to be provided along with the RERA website address. Of course, the font, they have also clarified that the font size of the RERA number as well as the Gujarat RERA government, the website address needs to be equal or more than the contact details. So developers used to provide the phone number in big fonts, which attracts more attention, and the RERA number as well as the website address used to be in very small fonts, which were not visible. So to stop those practices, the authority came up with circulars, and based on that, now these details, now these compliances are being followed by most of the developers. So what has happened with this is, any advertisement that you look at for a real estate project, you can just log on to that particular RERA's website, search for that through the number provided, and all the details of that project will be available. I'll give you examples of how this happens. So these are two advertisements in this project. As you can see down below, I'll just point it out. So this part, RERA number, is this is the Gujarat RERA number provided by the authority, and of course the Gujarat RERA website address. Similarly, this is for Maharashtra. So MahaRERA registration number and the MahaRERA website address. So essentially, what any person, any allottee, any prospective buyer, a competitor, anyone can log on to the website of the authority, punch in these numbers and the entire detail of the project, the current status, how much construct, what is the stage of construction, how many units are booked, how many are unsold, all of those details, along with the documents, so land documents, documents of the approved plans, all of those are readily available on the website. So due to this, a lot of transparency has come into the industry, and accordingly advertisements have changed by providing only those things which are actually, or by promising only those things which are actually being built or constructed, ultimately delivered. So we're coming on to the next part, project planning. So what changes have happened in the project planning? So a lot of us as practitioners in RERA, or probably as chartered accountants who looked at plans of various projects, or probably even as investors when we're investing into a project, we usually look at the land documentation but fail to look at the actual approved plans. What we have done here is we have seen what changes have happened into the planning stage of the project itself. So earlier we had seen a lot of agreements with the landowners which would be either notarized or signed, not registered. The landowner and the developer would set up a system wherein the payments would be paid, payments towards land would be paid for over a period of say a year. Ultimately, the project was launched at the start. Money would have been collected from the customers. Part of it would have been paid to the landowner, and the landowner would have ultimately, over a period of 12 years, gotten the money. Subsequently, the sale deed was registered and the actual project on paper would have started. Post RERA implementation, all of those practices stopped. RERA said nothing doing. If you want to start a project as a joint development with a landowner, if you want to pay it in installments, you get a development agreement registered. So this is particularly for Gujarat, where they have clearly stated that any development agreement needs to be registered. Only then the RERA authority will grant the registration. What happened earlier was, along with this, in the mid of the project would change hands. So I would have booked an inventory with X developer. He would have done it for say 2 years, completed half of the project, and suddenly he would have felt that I don't want to continue with the project and sold the entire project to Y developer. Now I had booked the unit trusting on the, or based on the reputation of developer X and based on the promises made by developer X. But ultimately the delivery of the unit would have been given by developer Y, which would have changed or varied the terms as well as the promises made at the start. So this was a problem which was envisaged, and according to that, Section 15 was introduced. So to give you a brief of Section 15, if a project wants to change hands, if a developer X wants to transfer the project to developer Y, then the application has to be made through Section 15, wherein the two basic requirements. So there are a lot of requirements based on the state, but the Act provides there are two basic requirements. First, prior consent of the RERA authority is required, and second, consent of 2/3 allottees is required. So without the consent of the majority or 2/3 allottees and the consent of the RERA authority, a project cannot change hands from one developer to the another. So project planning, now the developers are very conscious of this and have started planning the project well in advance, and they don't have that option or leeway to subsequently change the promoters. Another big change that we've seen is a lot of plans are now passed and ultimately constructed as per the development control rules. So here in Gujarat, we have the GDCR, wherein how the planning is to be done for the project, what all rules have to be followed are clearly laid out. So earlier, probably in 2017-18, what we saw, a lot of plans were developed, a lot of plans were passed according to one set of rules. Say parking would have been shown in a particular area, but when you saw the actual construction, another say a gym or a common area would have been planned by the developer there. So those all have reduced now. When we see plans in say 2023, a lot of plans have been revised or changed subsequent to implementation of RERA. I'll give you an example in the next slide, wherein how the plans have been changed. Moving on to supplier contracts. So section 14.3 gives a defect liability of 5 years. Any defects in the construction quality with respect to say structure or services or otherwise, the developer needs to rectify those for a period of 5 years at its own cost. So because of that, a lot of emphasis of quality has been increased. So we have seen with our clients, with developers, we have seen actual hiring of quality control engineers. So people are laying more emphasis on quality because they don't want the hassle of maintaining a project for 5 years once the project is already complete. Similarly, what we've seen is a lot of contracts have been changed. So contract management, and say a developer is giving a back-to-back contract to a reputed contractor. In that case, the agreement itself points out and says that 5 years, if there is any defect, then the contractor is liable. So the developer, in sense, is also taking that assurance from the contractors, so that the contractors are also quality conscious, and the end product is in a much better shape, and at least for 5 years there are no issues with respect to quality. Again, there are lesser alterations that are being planning. The revisions in plans have reduced over a period of year, because again 2/3 consent of the allottees is required each time you change anything in a project. If the change is within a unit, it's qua a unit, in those cases consent of that particular allottee is also required. So any alterations, there is a process to be followed, and hence the developers are very conscious. They've started implementing projects on a basis where they don't need to change anything what they planned from the day one. So these are the major changes that we have seen across the project planning stage. As an example, if you look at this plan, so these are snapshots of plans. If you look at this part, so I'm talking about this security cabin box. I don't think I've seen a security cabin being passed in a plan for at least 3-4 years of the implementation of RERA. But because of the change in the norms, even the fire norms have changed. lot of plans now have been approved with the security cabins. Usually, these all cabins were constructed post receipt of the occupation certificate or the CC. This is another plan wherein the society amenities have now been planned in the hollow plinth. Here, hollow plinth parking. So usually, before the implementation of RERA, plans were passed where hollow plinth was majoritarily shown as a parking space, and ultimately, post receipt of occupation or completion certificates, society amenities were planned and constructed in the parking space. Even if you look at swimming pools, earlier swimming pools were passed as water bodies rather than swimming pools because the norms for swimming pools are quite specific. But because of the implementation of RERA and certain litigations that have been happening with respect to planned versus actual, the developers have become more conscious and they have started putting these in actual plans and then implementing it in the way that the plans have been passed. Moving on to what changes we have seen in the accounting, documentation, and banking parts. This is the third part of the entire presentation. So, legal documentation, now there's a flow. Earlier, prior to RERA, there were no specific standard set of documents which were to be provided. Usually, the developers would enter into an agreement, and subsequently, when the project was complete, a sale deed was registered and executed. But now, post implementation of RERA, first allotment letter has to be provided at the time of booking. Then, when 10% amount has been collected from the allottee, an agreement to sale has to be registered. Subsequent to the receipt of completion certificate or OC, a sale deed has to be registered. And if the possession is not given along with the sale deed, a possession letter or a possession agreement can be followed. So, section 11.3 talks about an allotment letter that needs to be provided at the time of booking, along with approved plans and the time schedule for completion. So, the allottee has the right to know how the progress of the project will go. So, time schedule of construction is required, along with all the approved plans is to be provided. Then agreement to sell. Of course, agreement to sell will detail all the clauses with respect to the agreement, with respect to the understanding between the developer and the allottee, and subsequent to the completion, the sale deed has to be registered. So section 17.1 says that sale deed needs to be registered upon completion of the project, and if there is no provision in the local laws, it has to be done within 3 months from the receipt of the occupation certificate. Why possession letter or why agreement for possession is essential? In case the sale deed does not contain provisions or clauses with respect to transfer of possession, physical possession, the defect liability period of 5 years that we talked about in section 15.3 states that the defect liability period shall start from the date of actual possession. So if the possession is not specifically stated, the date of possession is not specifically captured in any document, then the calculation for those defect liability periods becomes a big task. Hence, the insistence on either providing a possession letter or including such clauses in the sale deed is given upon. What changes have happened in the accounting and the compliances? So, post implementation of RERA, a chartered accountant certificate is to be provided for each project. It has to be provided quarterly, and this is common for almost all states, wherein the chartered form 3, as it is called, chartered accountant certificate, is given, and details of bookings, details of cost incurred and paid or cost incurred, and how much can be withdrawn from the separate bank account is defined in the form 3. Now, a project under section 3 is registered as an individual project. So, a promoter, if you talk about income tax, if you talk of GST, a promoter basically is registered. So, you take registration of a firm, of an individual, or of a body corporate. While in RERA, it's not the promoter that is being registered, it's a project that's being registered. Hence, the key differentiation is when a project is being registered, a firm may have 10 different projects, and every project has to the chartered accountant has to provide Form 3 for every singular project that has to be registered. If a project is divided into phases, phase 1, 2, 3, and so on, and project is being registered as a separate phase for each project, separate books of accounts need to be maintained. Hence, every Form 3 for issuing a project for issuing a Form 3 for each project, separate books of accounts need to be maintained. It may be maintained in a singular accounting package, say Tally. Different cost centers can be maintained, but ultimately a differentiation between each project in a promoter group has to be made. What key changes because of this Form 3 and because of it being certified by a chartered accountant, a lot of other departments other than the RERA authority have also started relying on it. So income tax and GST departments have also started relying on Form 3 issued by the chartered accountant. Additionally, because agreement to sales have now been registered, the terms of payment, the terms of when the payment is to be made have been made clearly defined in the agreements, and those have been registered. So once those are registered, those are public documents. So if a agreement to sell states a clause that payment for this particular unit is to be made in 12 equal installments over a period of 1 year. So even if the payment is not made, the GST liability will arise. Hence, because of compulsory registration of agreement to sell, a promoter now cannot escape his GST liabilities with respect to payments where the payments have been due and yet not paid. Similarly, a lot of documentation is now required to be kept by the authority, by the promoters, because of the insistence of the authority. So here in Gujarat, Form 3 also contains details of all the allottees along with the KYC. So PAN, Aadhaar, passport or driving license, these details need to be filled in by the chartered accountant in the Form 3. So once these details are required by the authority, automatically the promoters are required to keep a proper record of all the allottees who have invested in their project. Now the issue comes when what happened prior to RERA, the flexibility was available with respect to bookings of family members. If I would want to purchase a unit, I would have given a check in my name to the developer. I would have completed the payment, but at the time of registration of document, if I would have said, okay, instead of me, let us get the document registered in my wife's name. Now, post implementation of RERA and of course, Benami transactions and all of those coming into the purview, it is always advisable to ensure that whoever has made the payment gets the document registered in his name. So with RERA, because details of allottees have to be captured and provided to the authority every quarter, once I have made a payment through check in my name, the name of the allottee to be entered into the Form 3 has to be of the person who is actually paying. So all of those leeways that the promoters used to take prior to implementation of RERA with respect to KYCs, with respect to registering of documents in another family member's name have now to be stopped. Another major impact with respect to compliances are the ancillary laws. So labor cess, whenever say here in Gujarat there is 1% labor cess or building and other construction workers cess which needs to be paid on the construction cost. Now the authority, the labor department, is relying on Form 2 and Form 3 certification of whatever cost has been provided there to the RERA authority. On that 1% needs to be paid by the developer. So automatically, if the promoter wishes to declare some other amount to the labor authority, now that has stopped, and whatever is being declared to the RERA authority is now being paid to the labor office as well. Similar, and whenever an environment clearance certificate is required to be taken for a project, corporate environment responsibility or CER has to be paid. It's approximately 2%. The authority in the future might look at RERA authority or the RERA certification for payment of such amounts. So the Labor Department has arrived early to the scene. They're already using RERA, the information available on the RERA website. Probably in a soon while, we'll also see the same for the other departments. So all of these changes have happened in the accounting and the compliances part. Coming to the banking stage, so these are the major two formats in which banking has been established. So post RERA, whatever amount has been collected, needs 70% of that has to be deposited into a separate bank account, and that separate bank account, the money can be utilized only and only for the payment of land or construction. So this is being passed in order to ensure that there is no diversion of funds from a project. So a promoter should not be able to collect money from one particular project and divert it for investing into another parcel of land or another project. Hence the requirement of 70%. So any amount that is collected from an allottee in the first case is deposited into a current account. From there, directly 70% it is transferred to the RERA account, and once by the three certificates, that is Form 1, 2 and 3, that is architects, engineers and chartered accountant certificate, if the withdrawal limit is available, this amount can be withdrawn to the current account or directly payments can be made from this account. So this is one way of doing it. The other way, which a lot of our clients also follow and which is a preferred way across various authorities, that the amount gets deposited into the collection account, wherein the auto split happens. 70% goes into the RERA account, 30% goes into the current account, and only once the certificate allows, the three CA certificate, architect, engineer and CA certificate allows, then the account is transferred to the current account from which all the payments are made. So these are the basic changes that have happened to the banking industry. All of the banks have come up with specific products which cater to these requirements. Major changes that have happened post RERA are in the borrowing and the means of finance situation. So what we've seen in the financial industry as well, in the banks, in the financial institutions, that they rely very heavily on the Form 3 or the chartered accountant certificate provided by the chartered accountant. So before sanctioning or even before disbursement of loans, here in Gujarat, a lot of banks insist that the project be first registered with the RERA authority. So they are assured that all the documents are properly verified, checked, and only then registration is granted. Second, whatever financials have been provided by the promoter directly to the bank in terms of means of finances, in terms of project cost, in terms of the receivables that they're estimating from the project, whether all of those declarations by the promoter match with the declarations provided to the authority by the chartered accountant. So banks and financial institutions insist on Form 3 before they disburse the amount. Subsequent to the disbursement, once a mortgage or charge has been created on the project land and the receivables or probably the units, the banks insist that those encumbrance, the mortgage that has been created, also be uploaded and declared to the RERA authority. So encumbrance certificate is then taken from an advocate and re-uploaded to the website for everyone to see. So if I as an investor want to go and look at a project, I can go to the RERA website and look whether a project loan has been taken, how stressed or how much money the promoter himself is pouring into the project. So encumbrance reporting to RERA has become a major benefit to the banking industry, wherein the customers, the allottees are also aware of the the situation of encumbrance on the project, and the banks are also clear that all of those details are disclosed. Another thing that has changed is the timeline for refunds. There was a system prior to RERA wherein if I want to make a cancellation for the unit, the promoter would have simply said that whenever this unit gets sold and the money I start receiving money from another allottee for the particular unit, only then I'll start repaying you. But once if a clause is not being specifically incorporated into the agreement, there is the agreements are silent, then RERA authority has defined the timeline for refunds. So 45 days, say here in the state of Gujarat, if nothing has been defined in the agreement, the promoter needs to pay back the amount to the allottee within a period of 45 days. What this has done essentially is it has impacted the project funding also. So the requirement, if there are a lot of cancellations in the project, a lot of refunds need to go out, it impacts the progress of the project and the ultimate requirement of finance. So a promoter now is very well, they understand the requirement of finance and how the project needs to go on, and proper cash flows are being maintained by the developers. Of course, because proper finances, the documents are done properly, those are being uploaded on the RERA website, and all information is readily available. A lot of banks have also started relying on construction funding, as it is called, to expand their portfolio, because the risk associated with funding a developer has reduced. A regulator, they know that the regulator is there protecting the interest of the allottees as well as ensuring that the project gets completed on time. With respect to banks and their status of encumbrance, there's a very interesting judgment which has been confirmed by the Supreme Court, and that is it belongs to the state of Rajasthan, and it is called Union Bank of India versus Rajasthan Real Estate Regulatory Authority. So why this case law is interesting is because let us look at the facts first. SNG Real Estate, the promoters launched a project called Sunrisers. There were 38 flats and 9 were already sold. In 2016, the promoter took a loan of 15 crores from the bank. So now Union Bank of India, earlier it was Andhra Bank, and they created a charge or a mortgage on the entire 19 flats, including the 9 flats which were sold. Now the developers, the promoters, failed to repay the amount, and due to the non-payment of the said loan, auction proceedings were initiated under section 13(4) of the SARFAESI Act. Allottees, the 9 unit holders who were there, approached the RERA authority under section 11(4)(h) of the RERA Act. Now, what section 11(4) says? Section 11(4) specifically says that after an agreement is executed, and after an agreement to sell is executed, no mortgage or charge can be created on such apartment. And if any mortgage or charge is created, then it shall not affect the interest of the allottee who has taken or agreed to take such an apartment. So the RERA authority, so this went from the RERA authority to the Rajasthan High Court and then got confirmed by the Supreme Court. What were the key issues and the key takeaways from the judgment were? The court held that the complaints against the banks can be filed before the RERA authority if the bank has taken possession of the project. So essentially, the court held that now because the bank has taken over the project, the bank is now the promoter of the real estate project under the RERA Act, and hence action can be taken against the bank and the complaint can be filed with respect to the providing the ensuring the rights of the allottees are secured. So once the bank takes action for enforcing their security interest in the terms of 13(4) of the SARFAISI Act, the secured creditor for all purpose enters into the shoes of a borrower or a promoter. So as soon as they enter into the shoe of the borrower, the complaint by the allottees can be filed against the bank as well. Of course, the SARFAISI Act was implemented in 2002, which has a provision saying that notwithstanding anything contained under this act, so it takes precedence over all the acts. However, RERA Act was passed in 2016, and hence, in case of conflict of both of these central statutes, the legislation which was enacted later, that is the RERA, would prevail. So RERA prevailed over SARFAISI Act, and the third key takeaway was that this would not have a retrospective effect on the banks. So if prior to 2016, before the implementation of the RERA Act, if a mortgage or a charge has been created, then it would not affect the rights of the bank towards it. Coming to I feel this I've kept it at the last, but I think this is the most key change that has happened in the age of information technology. Now, a lot of information which was not available previously for projects is now being available. So every investor, every customer can take a very informed decision. So before we move on to what transparency and how information flows under the RERA Act, I want to highlight and appreciate the way transparency has been inbuilt into the RERA authorities themselves. So I'll take you through this is a screenshot of the Gujarat RERA website portal, wherein if you look at a project, once it is applied for registration, where the file is moving, it can be monitored from the comfort of your offices. It can be looked at. So where the file is moving, the entire movement is displayed on the website. And currently, this project was with Finance Group 2. So there were 3 departments: the TP Group, Finance Group, and Legal Group. And currently, the file was scrutinized with the Finance Group. So this is the level of transparency that the RERA authorities are maintaining, wherein even the promoters can track where the file is currently available and who is checking the files. With respect to what transparency this has brought into the real estate industry, I'll give you a small example. So this is another screenshot from the RERA website. This is a grid-like inventory portion, wherein all the yellow fields, all the units which are yellow, are basically booked inventories, and all the ones which are blue are unbooked inventories. And if you hover on any of the unit that is booked, so if I put my mouse on one of the units, it will automatically show me a concealed name. So if I am the person who has purchased that unit, say A301, and the name is Anil something. So the AN and the last letter of the name would be displayed. So I would know that this is the inventory booked in my name, and it is also disclosed to the RERA authority. But another person would not know who has booked this unit. So this is a brilliant way of implementing and bringing in more transparency. So anyone can verify whether the booking that he has made, the payments that he has made towards the unit, are also being displayed and shown to the RERA authority, the regulator as well. Other than these, the documents that are usually available on the RERA portal, inventory status. So I would like to talk about these with a little emphasis on certain points. Inventory status. So before going for booking, before entering into the office of the developer, a person and prospective buyer can look at the inventory status. Out of 100 units, how many have been sold, which ones have been sold, and how many are unsold. So a complete information is available on the website of the RERA authorities. Again, construction status and the progress. So bar charts and construction progress are shown, wherein progress photographs are also displayed, and what is the percentage of completion of the project is also displayed. So if a project is showing on the RERA website as 50% complete, the timeline as well as how much is the completion and how the project has moved on along with photographs can be viewed at the RERA portal. Promoter details. So all of the details. So who are the promoters? Details of their partnership. Who are the, so if a promoter is a firm or LLP or a company, who are the directors or the partners of the firm? What are the addresses? Even the financials. So last 3 years income tax returns along with balance sheets, profit and loss, audited statements, all of those are available in the public record for viewing. So before making an investment in decision, an informed decision can be made through the strength of the promoter's financials. Very important point, which is also available, are the land and the title details. So whenever you're buying an inventory or a unit, it is necessary to ensure that the title of the land is clear, and encumbrance certificate along with title reports, title certificates are all uploaded on the authority's website for public viewing. So if there is any litigation, if there are any encumbrances with respect to certain loans taken, all of those are also disclosed and displayed on the authority's website. So all of these details, since they are available, a lot of transparency has come, and a lot of people are willing to invest in other states, other territories, based on information available for public viewing. Again, plans and NOCs. So all no objection certificates from the fire departments, from the airport authorities, from the environment clearance authorities, all of those are also uploaded and displayed. Of course, the layout plans, approved building plans, section plans, elevation plans, all of those are prominently displayed on the website for any person, whether an allottee or a prospective buyer, to view. Brochure, a very important document based on which the promises are made, the promises are defined. So a brochure will tell you of how the project is going to look like, how the project is going to come up, and what are the amenities and specifications for the particular project. So if a promoter promises that a particular type of window is to be provided, or a particular type of flooring is to be provided, all of those will be contained in the brochure and available for public for viewing forever. So even after the project is completed, even after everything is closed, the project is winded up, this brochure will be available, and for even for the subsequent sales, this brochure can be viewed and used for. Project timeline. So as we started with the presentation, the first point that we discussed was a project needs to be given a particular project timeline, that this project shall be completed on this particular date, say 31st December 2026, and that the allottee as well as all the other stakeholders, so banks, authorities, allottees and suppliers, all of them know that this is the time frame within which they need to make the payment or complete the work. Of course, agencies, so architects, engineers, structural engineers, all of those details are also provided on the RERA authority's website. So if you want to go and have a look of who the developer is, what type of agencies they are appointing, all of those are displayed on the RERA portal. Financials of the promoter we already talked about. Balance sheet, profit and loss, all of those documents are available. Legal document drafts. So allotment letters, agreement to sell and sale deed, all of those are to be uploaded on the RERA website at the time of registration itself. So if you're going to invest or book a inventory, you already know what kind of format or what kind of document the promoter is expecting you to sign in order to close the booking. So allotment letter drafts, agreement to sell drafts and sale deed drafts, all verified by the authority, are uploaded on the RERA website. So they ensure that certain clauses which are in favor of the promoter or usually which are one-sided and against the RERA Act do not enter into the legal documentation. Hence, at the start itself, they ensure that the litigation reduces and whatever is being captured by the RERA authority is being ultimately executed, and chances of litigation reduces. Once the project is completed, the OC or CC certificates are received, the societies or the entire project is being handed over to an association of allottees. All of those details are captured in the project closure details. So at any point of time, once a project is completed, a person can log on to the website and get the OC and CC certificates. They can get the registration of the association of allottees, and they can also download and keep it there for their record. So with this, I would like to conclude that there have been tremendous and very encouraging changes in the real estate industry post the implementation of RERA. I feel that the implementation of the act, which has now been implemented across all the states, West Bengal being the last one to join the foray, the proper and effective implementation of the RERA authority can do what SEBI did for the stock markets. So I foresee a situation where investment into real estate becomes as easy as investment into shares because of the transparency, because of the easy availability of information through the RERA website. With this, I would like to thank you for a patient hearing, and if there are any questions, I would be glad to take them.
Yes, sir. Sir, we have a couple of questions. May I please?
Yeah, sure, please, ma'am.
Okay. So the first question is, sir, if the buyer buys before the occupancy certificate, then is the registration required for the agreement of sale?
So either ways, the provisions of the act are very clear that a promoter cannot take an amount exceeding 10% without first entering into an agreement to sell. So even if the occupation certificate is not received, which means the project is still ongoing, in those cases, of course, it is required. But where an occupation certificate has already been received, the project is already completed, in such cases, the RERA authority may take a lenient approach and allow execution of the sale deed directly rather than the agreement to sell. But there is no provision in the act which says that it is okay not to register the agreement and directly execute the sale.
All right, perfect. So the second question is, what are the basic conditions for RERA registration?
So the basic conditions, the first condition being that it should be in the planning area. So planning area is defined by the specific state, and the say here in Gujarat, wherever say ORDA or AMC or some municipality or Nagar Niyojak is there where the plans are passed, those are all considered to be part of planning area. So first condition being the project is within the planning area. Mind you, certain states have notified that the RERA implementation will be done across the state irrespective of the planning area. So they have notified the entire state as the planning area. The second condition being certain exemptions are given. So exemption if there are less than 8 units or less than 500 square meters of plot of land on which the project is being developed, then in such conditions, exemptions are provided to the promoters. In all other cases, after 1st May 2017, wherever occupancy certificate has not been received, RERA registration is compulsory.
Perfect, sir. So the last question is RERA applicable for land promotion and sales?
No. So if so, you have to look at it as from the point of view whether sale of land falls under the category of a real estate project. So if you're buying a land, plotting it, putting different plots on it, developing the roads, the drainage, the sewage system, the lights, all of those you are providing, getting the plans passed, then yes, of course, sale of such individual smaller plots of land will fall under the RERA purview. So if it's a development of a project, then yes. But if it's a sale of a particular piece of land without development, then it will not fall into the RERA purview.
Perfect, sir. All right. So I think these all were the queries that were received from the participants, and I'm sure, sir, you have explained it just so well. So shall we conclude it, sir?
Yes, ma'am. Thank you so much for having me. I would
That's
like to thank all of you for attending.
Well, let me also, before I validate, let me thank Sarthak sir for, such a prolific session, I would say, sir. Each and everything was, unraveled just so meticulously, I would say, sir. And the deliberations that you and Palak sir have made today, I'm sure were, truly enriching, sir, and would be really beneficial to all the participants present today. Thank you so much, sir, for sparing your invaluable time to enlighten the members, I would say. And, truly, I believe that you and Palak sir both have justified the purpose with which this webinar had actually been organized. So thank you so much, sir, for that. Well, before, my dear friends, I conclude, let me also, remark a proficient sense of gratefulness to the CP committee of ICAI and its entire team led by CA Purushottam Khandelwal sir and CA Gyan Chandra Mishra sir for their untiring efforts that they are putting in for coordinating and organizing such intensifying webinars for the benefit of the members. So thank you CP committee of ICAI for that. And on this note, my dear friends, we shall now conclude and thank you and have a good day ahead.